Welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500 doing a 5-minute stock analysis. Today we are looking at Air Products and Chemicals, ticker APD. In the next 5 minutes, I'm going to go through this company, and this is my first 5 minutes of due diligence from the company live for you. How I value it, how I think about the business quality. Let's go. So first up, we look at industry. This company is in the chemicals industry, so it tells us a little bit about what they're going to do as the chemical. So they are selling chemical products with a focus on atmospheric gases, process and specialty gases, equipment, and services worldwide. So it's not just products, they're also providing services. So they manufacture and produce these gases and also providing air separation units and generators for customers in various industries. Strategic combination with Baker Hughes to develop hydrogen compression systems. So they're based in the U.S. They have a beta of 0.83. This is attractive to me. I like that it's below 1, and I like that it's not just barely below 1, but almost 15% below 1. That's very attractive. It shows that they're going to be perhaps a higher quality business. Share turnover 123% doesn't really tell us much other than a low shareholder base. Now, return on invested capital is where I like to go next. Again, we're on quickfs.net where I can do these quick analysis. First thing I see is because this is all positive numbers, they had no losses in the last 20 years. That's a very positive sign. I like companies that aren't going to have losses. Now, as I look back, we're somewhat steady, but there's a little bit of fluctuation. So you have like 8%, 6%, 9, 9, 11, 9. You're really hitting around that 9% range for this return on invested capital. You're never really above 10 for much. And then you have this weird blip in 2017. But other than that, you're kind of hugging 9, 10, 11% with a few smaller years and a few bigger years. It's a little low, but if you have some debt, you could get the return on equity up to 15% plus, which could be attractive. So I'd like it a little higher, but no losses. That's a very good sign. Next, I want to look at the 10-year median returns. Here we see return on assets at 7%, invested capital at 9.9%. Again, that's that 9-10% number. And return on equity at 15.7%. So that's what I want to see. It's showing that with a little bit of intelligent leverage, they've been able to push the return on equity up into the acceptable range for me. Now, the PE is at 26.7. That's high. I'd like it to be under 15. That's really where I want to buy companies at 15 or less. But really, the way that you justify that is with high growth. But unfortunately, the revenue growth is at 0.7%. That's bad. In addition, you have asset growth at 6.7%. So when assets are growing faster than revenue, it's a really bad sign showing future returns are unlikely to be good because your return on invested capital is going to go down if your revenue is actually growing really slowly. Now, the only difference is if you can grow earnings faster than your assets. That's very hard to do with low revenue growth. And as you can see, their assets are growing faster than earnings, which means that over time, return on invested capital is going to drop and return on equity is going to drop. So not good here. You don't have high gross profits, but let's see if the gross margins are similar. So gross margins aren't very stable. They've grown from 26% up to 30%. So not a super strong business here. Earnings per share have grown from about $5 to $9.43. I'm wondering if this is due to buybacks. So because you don't have a lot of revenue growth, let's see what our shares diluted have gone. So you had 211 and you went to 212. So how did they do that then? Gross profit was at 2.5 billion. It's grown to 3.1 billion. So it has grown. Operating profit has grown, and then they've kind of just like leveraged that to a double. Okay, so not a lot of revenue growth, but it's been enough to allow them to achieve okay returns. Balance sheet, let's see what our debt situation is. Long-term debt's doubled from 4 billion to 7 billion. Not terrible. And cash flow. How are we doing with cash flow? So again, every year has positive cash flow from operations. That's a good sign. They're investing a lot of that back to PP&E, but they're not getting growth. So this is just the main problem here, is they earned 3.3 billion in profit or cash flow from operations, and they bought 2.5 billion in PP&E, but you're not seeing that flow through to earnings. And so that's a big red flag for me. You're not getting the justified earnings growth that you should for that level of investment. So I don't like that assets are growing this fast when revenue isn't. And I think it sets up for longer term declines in return on invested capital, which means you're not going to get a sufficient return on your equity without really intelligent use of debt. And the only way they're getting away with this so far is that probably the cost of debt is low due to low interest rates right now. So I'm concerned. For me, Air Products would be a pass based upon what I'm seeing here. Won't get included on my watch list. Don't forget to like this video, hit that subscribe button, and hit the bell in order to get notifications when new videos are uploaded. We're working through every company in the S&P 500. I hope you will join us for this great segment. Again, we're using QuickFNS. This is what I use to do my 5-minute stock analysis. Thank you for listening, and until next time, stop paying fees, start building wealth.